Now, the continent's financial forecast is out. Africa 54's Ndimyake Mwakalyelye joins us now with the numbers. Hello, Ndimi.
Well, thank you, Vincent. Good news and bad news. The International Monetary Fund has released its 2014 Economic Outlook for Sub-Saharan Africa. The report highlights the risks and opportunities of the region's financial systems. The IMF is predicting a 6% growth in the economy of Sub-Saharan Africa in 2014, a 1% increase from this year. The report cites investment in infrastructure and production capacity as reasons. The IMF says the growth is lower than previously predicted because of weaker global economic conditions, budget delays in oil producer Angola, and oil theft in Nigeria. Like the past 3 years, the IMF expects a less than 6% inflation in 2014 due to better food prices and monetary policies.
It's true that we have not seen a huge uptake in food prices as we did a few years ago. But there have been countries that have had to deal with issues, sort of drought and other conditions that have impacted food prices and have still been able to tame inflation. So I think monetary policy has had quite a bit to do with it.
The fund predicts the strongest growth in mineral exporting in low-income countries like Mozambique and Sierra Leone. The report predicts only a 2% growth this year and 2.9% next year for South Africa, due to the relative maturity of its industrial, extractive and services sectors. Meanwhile, the World Bank sees growth of 5.3% for Sub-Saharan Africa in 2014, underpinned by strong private and public investment. The IMF gave similar policy prescriptions to previous reports. It recommended African nations allow their currencies to fall if pressured by low commodity prices or capital outflows rather than popping them up too much. Some nations, like Nigeria, intervened to prop up currencies after portfolio outflows surged between May and August.
We certainly don't dispute that there are occasions when there's undue volatility that needs to be dealt with. We don't see an undue use of or undue effort to stop the exchange rate from moving. And certainly we advise that our countries don't do that.
The IMF also says that African economies are more vulnerable to volatile portfolio flows than ever before, suggesting capital flow measures or restrictions on capital coming in or out should only be used to combat volatility as a last resort.
First line of defense when you're facing volatile capital inflows really should be trying to see if the macroeconomic policy settings need fine-tuning. If that is not working, and then with the another second line of defense, if you will, would be looking at macroprudential policies. So if you're worried about these inflows coming in and inducing either excessive credit bubble, asset bubble, you want to try and mitigate those by, for example, tightening the extent to which banks can lend credit. And then if these either macroprudential policies or macroeconomic policies cannot be recalibrated in time, then you want to consider the use of capital flow measures. I think what's interesting is that in recent years, capital flow measures have been adopted both for capital coming in to try and slow down the extent of inflows, but also going out could be considered.
Now, despite the strong growth outlook, the IMF report warns that the region remains vulnerable to lower commodity prices and a slowdown in developed and emerging economies.